Hello, and welcome to the latest Expert Series webinar. Today's presentation is The Power of Zero, Effective Strategies for Limiting Interest Rate Risk. This is a complimentary Index Universe webinar courtesy of ProShares. I'm Ollie Ludwig, the managing editor of ETF.com. We are the leading authority on news and data about ETFs, and also the company behind Inside ETFs, the world's biggest ETF conference that just concluded last week in Hollywood, Florida. Joining me today are Simeon Hyman and Stephen Sachs, both of ProShares. Simeon is the head of investment strategy at ProShares. He leads the company's team of investment professionals, and he engages in portfolio analysis, product research and development, and the education and delivery of investment strategies using the company's alternative ETFs. Stephen Sachs, meanwhile, is head of capital markets at ProShares. He has more than 20 years of experience in the institutional trading community. And Sachs' knowledge and his expertise have made him an often quoted source for publications including Barron's and the Wall Street Journal. Now, a bit of housekeeping before we get underway here. I may chime in with a few questions along the way, but everyone should know that there will be a Q&A at the end that I'll moderate. All of you can ask questions at any time during this webinar in the window at the lower right of your screens. Also bear in mind that the presentation will be available to all of you 24 to 48 hours following today's webinar. Now, before I hand it over to Simeon, I'll just make one note. We all know it's no secret that bond yields began to move higher since the Federal Reserve first signaled that it would soon begin pulling back on quantitative easing. Since the former Fed Chairman Ben Bernanke's May 2013 speech, yields on 10-year bonds more than doubled in the rest of the year to about 3%. With that in mind, I'm going to hand it over to Simeon Hyman, Head of Investment Strategy at ProShares. Please, Simeon.
Thanks so much, Ollie. So, it's always a challenge to talk about the risk of rising rates. When we actually had the last 10 days, rates came down for the first time actually since, the Fed made the announcement of tapering. But I wanted to put some historical context because it's easy to get caught up in the headlines of the last few days. But let's just remember that, rates are still in the vicinity of historic lows. We have gone through a 30-year period of a decline in interest rates that, incessantly brought rates down to levels, not seen in generations. So, the fact that we had a little bit of pullback in the market from risky assets and a little bit of a decline in interest rates in the last couple of weeks is perhaps, I would suggest, not a reason to stop talking about the risk of rising interest rates. And that risk is real. Just a little quick reminder about bond math. Remember the notion of duration. Duration is the number that tells you what your risk is to a movement in interest rates. So just a quick, simple example. If you had, for example, a portfolio or an individual bond that had a duration of 5, that means that if interest rates rise just 1%, and as Ollie noted, they actually rose about 1.5% from the middle of last year till the end of this year, that portfolio, just moving 1%, would have lost 5% of its value, or $5,000 on a $100,000 bond portfolio. Remember, these are environments where yields are quite low, so you could easily wipe out an entire year's worth of interest just with a bond portfolio with a duration of, say, 5, which, by the way, is somewhere in the vicinity of the average duration of the entire U.S. bond market. So there's lots of reasons to talk about, what the risk is out there. Now, Ollie noted that, rates have risen substantially, from that tapering announcement, and we are now in tapering. So we've actually had 2 rounds of the Fed cutting back on their bond purchases. And just to put, again, this very recent decline in rates in perspective, over the last 2 days, almost half of that little downturn in rates actually returned back to the market. So, again, the betting person probably is still thinking that we are in an environment where the odds are that rates will rise higher. It's never a straight line, but the expectation for higher highs and higher lows. And I want to hand it back to Ollie for a minute just to look at how investors have been, speaking with their feet over the last year or so.
Thanks, Simeon. We track flows here at ETF.com every day. It's one of our obsessions, and this was a fun one to look at last year. It was the talk of the entire financial markets, really, ever since that Bernanke speech in May of 2013. And lo and behold, at the end of the year, there were net inflows. That was somewhat of a surprise, of about $9 billion. Not much in comparison to the year earlier inflows, so clearly indicative that something was changing, but still net inflows, and I think that plays into what Simeon was saying, that a betting man has probably got to conclude that rates are going higher, and therefore this discussion of what to do in that environment today in this webinar is totally topical. Now, when you get a little more granular and look at just what that $9 billion in net inflows looked like, when you got under the hood, it's very interesting. People ran for cover with short duration. If you look at the bottom of this slide here, the 23.7 billion of short and ultra short ETFs that's really a big part of why there were net inflows. And then, of course, on the outflow side, it was mostly the broad funds, the big aggregate funds, the HYHG and BND come to mind, certainly. So that's sort of a wash. Almost like a zero-sum game, people running for cover from slightly longer duration in these big, broad aggregate funds into the short end of the yield curve. And in the middle of the curve, it kind of offsets itself, inflows and outflows. And interestingly, the difference seems to be that brought flows into the positive zone, that is to say net inflows, was floating rate ETFs. And I think that fits very well, dovetails very elegantly with what we're talking about today, because what ProShares is talking about here are different ways to protect yourself in this rising rate environment. So that's a little color, I think, that we can sort of catapult into the next part of the discussion. So, Simeon, please take the floor again and take it away.
Thank you, Ollie. So what I wanted to do for just a minute is just walk through some of the pros and cons of the way that investors have been addressing rising interest rates, and you saw that from the flows. And I want to keep it simple here because you see folks talk about bond strategies that can go anywhere and various approaches to interest rate, dealing with rising interest rates. And all these approaches fall into basically one of two categories. If you're worried about rising rates, you can do two things. One, you can simply go into shorter-term bond funds, and that's exactly what Ollie just showed in the flows. Now, the pros from that are obvious. That's duration, right? If that goes down, your sensitivity to rising rates goes down. If you bring your duration from 5 to 2, you've dramatically decreased the impact of rising rates on your portfolio. The downside of that is, number one, you can't completely eliminate interest rate risk. So if you still had a duration of 1 or 2, you know what? If rates increased 50 basis points and you had a duration of 2, you'd still lose 1% on those bonds. So that's still some risk. Of course, the yields are very low, and investors are painfully aware of how low they are when you're in shorter-term bond funds. And there's limited upside, which is just what if we're wrong? If interest rates go down and you have low duration and shorter-term bonds, you don't have a lot of upside. On the other side of the coin, there is the opportunity that some investors have sought to increase their exposure to credit, to things like high-yield bonds, to things like bank loans. And the opportunity there is for enhanced yield. If you take some risk, you're going to get some extra return. There's a broader menu of opportunities. We can look at emerging market bonds. We can look at high-yield municipal bonds. So it broadens the universe of things you can look at. And there is the opportunity, if interest rates are rising because the economy is getting better, sometimes those spreads, those credit spreads, the extra yield that those instruments yield over Treasuries can compress, and you can actually get an increase in price from that when interest rates rise, if it's because the economy is getting better. The cons are you can still have significant interest rate risk because many of these strategies are not short in duration. So even though they have credit exposure, they could have substantial duration. And also, there is a challenge of perhaps substantially altering the risk profile of your fixed income allocation. There are a lot of euphemisms for credit risk in the environment, and some investors may be not intentionally, but perhaps unintentionally, increasing the risk of their fixed income allocation. So let me just give you a couple of snapshots numerically and quantify the challenge here. So we mentioned the pain of the low yield and short-term bonds, and there they are, right in front of you. Several choices for durations of somewhere around the 2-year mark, and all returning not much more, perhaps all the way from 25 basis points to the best case scenario, about 150 basis points, about 1.5% in municipal bonds. But not a lot of opportunity for yield, but you have reduced your interest rate risk. So if you then went to the other choice and decided to take more credit risk, there are opportunities. Emerging market bonds, high yield bonds, in both Europe and domestically, all are yielding in the 5, 6, and 7% range, but look at those credit ratings, deeply into below investment grade, and that's real credit risk. So even if it doesn't say things like high yield in its title, if it says something like go anywhere, if you've got credits in the BA, B, and CAA range, that's real risk of perhaps even default at the extreme, but certainly credit exposure. And as I mentioned, those credit opportunities often still have interest rate risk. So just looking at some of the general credit indices, U.S. high yield, global high yield, emerging markets, and European high yield, those all have those durations in that sort of 4 and 5 and 6 year range. So again, that's risk. Remember, duration of 5, 1% increase in rates, you can lose 5% on those type of products. Ollie mentioned that 2013 saw large inflows into bank loans, and the notion there is a simple one. Well, if I want some credit exposure with limited interest rate risk, how can I go wrong with a high-yielding product that has floating rates? Just a couple of thoughts, because so much has flown into that asset class that it's worth thinking about it just at the next level of granularity. And a couple of sort of asterisks there. One, the floating rate aspect of bank loans does offer some protection from rising rates, but what a lot of investors are not aware of is the fact that those products generally have, those bonds I should say, generally have floors on their interest rates. So they are not allowed, in effect, to provide a yield that's less than some percentage over a risk-free rate that might be 150 basis points. And we know that the federal funds rate right now is 0. So they're not going to float anywhere for a long time. Remember, tapering is not moving the target interest rate of the Fed. It's merely reducing bond buying. So rates have to rise a lot on that short end before you see them move at all. And a more subtle point, bank loans are callable, and that means they act like your mortgage. You can refinance your mortgage when interest rates go down. The issuers of these bonds can also refinance their loans when interest rates go down. So if, again, we're wrong, there's not a lot of upside if yields actually decline. So, what would we think is a good idea? A good idea is to be a little bit more surgical in the approach to dealing with fixed income opportunities and when you're worried about a rising interest rate environment. And what I would suggest is the first principle is to separate the interest rate exposure and credit exposure decision. First, should my portfolio, my client's portfolio, have interest rate exposure? If you have a ultra-high net worth investor who has more money than they need on the face of the earth, you might just want to have some very long duration bonds, not for a lot of the portfolio, but for some of it, simply as an anecdote to an end-of-the-world scenario like we saw in 2008. That's probably not most of your clients, but there are a class of clients for which that would be true. For most, you're going to want to, if you believe the rates are likely to rise, you're going to want to mitigate that exposure. And there's the opportunity to think about specifically hedging the interest rate exposure in your portfolio. And why do we suggest that as an important thing to think about? Because it allows you to split that decision up. Because then you can look at the credit exposure and determine whether you want to have more or less credit exposure than in your baseline allocation or strategy. Do I think that U.S. high-yield bonds are particularly attractive? In other words, are those spreads going to continue to compress as the economy improves? Or do I think they ran their course? Make that decision first, and then you know how much credit exposure, how much high-yield exposure you want versus how much investment grade or treasuries to be exposed to. And then you can then separately decide how much I want to hedge and protect that portfolio from interest rates. So splitting up those two decisions and considering hedging can allow you to take that surgical approach that can be a much more effective way to get to the right answer in the most effective portfolio for a broad range of client needs. And with that, I'd like to hand it to Stephen Sachs, my partner and head of capital markets.
Thank you, Simeon. Good afternoon, everyone. So I want to take this opportunity to introduce two particular funds that speak to this more surgical approach that Simeon just spoke about in managing interest rate risk. And that's IGHG, which is the ProShares investment grade interest rate hedged ETF, and HYHG, which is the ProShares high yield interest rate hedged ETF. As I said, we really think that these are two solid approaches to that more surgical viewpoint or that more surgical lens to your portfolio management and risk management as it relates to a rising interest rate environment. So on the slide, you really see the high-level overview of the two potential solutions here. So both IGHG and HYHG track indexes from Citigroup. IGHG tracks the Citigroup Corporate Investment Grade Treasury Rate Hedged Index, and HYHG tracks the Citi High Yield Treasury Rate Hedged Index. So it's, again, the investment grade version and the high yield grade version from an interest rate hedged perspective. Both indices are very similar from a construction perspective. They both take long positions in U.S. dollar-denominated bonds while attempting to mitigate the effects of the rising rates by shorting U.S. Treasury futures of an aggregate equivalent duration. This means that each of the ETFs targets a duration of 0 at their monthly rebalancing. The long side of both indices, and thus both funds, represent the more liquid investment grade and high-yield bonds available in the respective markets. They meet certain minimum issue sizes, certain maturities, ratings, and other criteria that really help build a liquid, tradable bond basket from the portfolio perspective. The Treasury futures in each of the hedges consists of 2, 5, and 10-year Treasury futures for HYHG and 10, 30, and what we refer to as the Ultra 30 Treasury future for IGHG. And we'll get into that a little bit more in a moment, but the idea is that you're taking long positions in the bonds inside the ETF on the index and a short position across a portion of the curve, or really the belly of the curve, if you will, in HYHG, and the long end of the curve on IGHG, to give you a little finer point on the duration hedge, as I mentioned, to ultimately target a duration of 0 at the monthly rebalance. So let's dig a little deeper. So how does IGHG target an effective duration of almost 0? We're going to, again, break down the two components of the index, which are thus the two components of the actual ETF itself. So if you look at the pie chart, IGHG's portfolio comprises an assortment of investment-grade bonds that have durations that actually range from shorter to longer term. The durations actually range from about 5 to 25-plus years. So ultimately what you get in the portfolio is a duration on IGHG right now of almost 10 years. And again, think back to a few minutes ago when Simeon was talking about duration and what that effect has on a portfolio in a rising rate environment. So now in order to offset that interest rate risk, or the implied treasury risk, if you will, there's a portfolio of short holdings of a roughly equivalent duration that has to be constructed for the portfolio. And again, for IGHG, we're using the 10-year, 30-year, and ultra 30-year treasury futures, taking short positions in those, rebalance on a monthly basis, as is the index, to give us a blended portfolio of short treasury futures to target that effective duration of near zero at that monthly rebalancing. The duration of this blended hedge can be manipulated to more precisely match the partial durations of the long portfolio against the interest rate curve. So ultimately, to sort of answer the question of why are we using various futures contracts, that really is why. It really puts a little finer point on the hedge itself and gives us a better way to target that hedge, again, to target that effective duration of zero. So let's talk about HYHG now for just a minute on the next slide. And really, the construction methodology is really very similar. What you're really talking about is a difference in the underlying long bond portfolio. So in this case, it's a portfolio of high-yield bonds. Again, the index is constructed using the methodology we talked about with various criteria around size, liquidity, issuance. But ultimately what you get from this is the portfolio's average duration of about 4.5. So again, in order to offset that interest rate risk, we're shorting 2, 5, and 10-year Treasury futures in an aggregate dollar amount that is equivalent to the long bond portfolio. So again, bring the effective duration of the portfolio to near zero, or effectively zero at that monthly rebalancing. So you've got the long side of the portfolio, you've got the short side of the portfolio. Both of those are embedded in the index and thus in the fund to give you that combination of the ability to hold the portfolio in the bonds, garner the yield, but be protected in a rising rate environment. So for the sake of comparison, let's look a little bit at the yield to maturity and duration of several of the traditional, investment grade and high yield bond indices that other funds follow and that are out there in the marketplace versus IGHG and HYHG. So this helps us to show visually and really quite clearly how rate sensitivity of HYHG's index compares to that of other bond funds. So broad indices like Bank of America, Merrill Lynch, Barclays, Market are all fully exposed to interest rate movements, right? They tend to have yields to maturity in the 1 to 4% range, durations anywhere from about 2 to 8 years for investment grade, and about 5 to 6 for high yield. With yields about 5 to 6% for high yield, and really durations about 2 to 4.5 for the high yield portfolio. Now, if you look at the Citigroup index, again, both have yields to maturity that are similar to the other indices, but the key element here is the substantially no duration, or in other words, very little sensitivity to rising rates. In fact, under current market conditions, as you may be able to see, the indices have essentially a target duration of almost zero. So again, that's the high level, encompassing sort of portfolio construction of both of these indices and thus the underlying ETFs in the portfolios. With that, I think I'll turn it back to Simeon to talk a little bit about this approach, how it makes sense given the market backdrop we have today, and really sort of the broad environment that we're in.
So, thanks, Steve. So just back to, where does this go in your portfolio? We designed IGHG and HYHG to be the surgical answer, which means that those underlying portfolios that Steve described, they're your regular investment grade and high yield allocations respectively. That means that they can replace directly your either all or a portion of your investment grade and high yield allocations. So again, I just hark back to the comments I made a little earlier. First, ask yourself, what's my baseline split between investment grade and high yield? Start from there. If I have a view, do I think high yield credit spreads got a little tight? Maybe I want a little extra investment grade than I used to. Do I think that the improving economy will continue to tighten those high yield spreads? Maybe I have a little extra high yield, but IGHG and HYHG are then ready to plug and play since their underlying long bonds are regular investment grade and regular high yield bond portfolios with that duration, with that hedge bringing the duration to zero. So very simple from a portfolio construction and asset allocation perspective. And Ali, I'll hand it back to you.
Are we ready for questions? Are both of you gentlemen ready right now? Is that what we're at now?
Ready, willing, and able.
Absolutely.
Perfect. Okay. All right. I want to remind the audience, first of all, that you can ask questions in the lower right of your screens at any time as we move through this. So let's get underway. Current yield and yield to maturity on both of these securities. Let's start with the investment grade one, IGHG.
Sure. So the yield on that long bond portfolio, if you will, for HYHG is in the mid-600s right now, and it's in the mid-400s for IGHG. So that's before the impact of any hedging, and the cost of hedging for each of those is in the 150 to 170 range for HYHG, and it's in the 250 to 275 range for investment grade. Now, that's a higher number for investment grade because remember, as Steve noted, the duration of IGHG's underlying bonds is considerably longer, so it's a little more expensive to hedge. I should make one important note at this point for those who are going to do a little due diligence and look at how these are performing or watch them on a periodic basis. The cost of the hedge comes out of the yield of the underlying indices. So you'll see a number that looks something like 450 to 500 basis points for HYHG if you look at the index. But when you own the ETF, the cost of the hedge comes out of the NAV. So those monthly distributions will be running more like that mid-600 basis point number. So it's very important. We apologize for that being a little point of confusion, but because the indices can go ahead and actually short the bonds, it's deducted from the yield in the index. We're shorting the futures, and that comes out of the NAV by standard accounting practice.
And it's an important point to focus on from what Simeon said from the perspective of how we're implementing the portfolio versus the index. If you look at the index, to Simeon's point, the index uses the cheapest to deliver bond in the index construction methodology. We actually implement inside the ETF portfolio using the futures for the underlying bonds. And the reason we do this is, one, the futures contracts always replicate the cheapest to deliver bond, and they are also, more importantly, far more cost-effective to use to implement the portfolio. They're just cheaper to trade, and thus, ultimately, you get a more effective portfolio construction because of that.
Okay. Thank you. Now, interest income distributions. Give us a sense of what's the monthly, quarterly, semi-annual?
Each ETF distributes income on a monthly basis.
Okay, perfect. Let's talk about expense ratios. Situate these in a competitive environment. I presume, I'm not sure exactly what you would compare them to. You could to the existing bond ETFs out there that are in the corporate sector that split the investment grade and the high yield sectors. And what do these ETFs cost?
The HYHG is 50 basis points and IGHG is 30 basis points.
Okay, and give us a sense of these securities have decent AUM. The investment grade one, correct me if I'm wrong, last I looked, $28 million. The high yield one, $82 million. That's decent. You know, you could probably get good trade execution. Can you give us a sense of what that's looking like in the traffic in terms of bid-ask spreads, how these securities are trading?
Yeah, no, absolutely. So HYHG was launched in May of this past year, and IGHG was launched just in November of this past year. So again, to your point, asset growth and actually average daily trading volume has really grown quite nicely on both products since launch, and they've been performing very, very well in the marketplace from that perspective. So keep in mind though that these ETFs are no different than any other ETF. liquidity actually comes from not only just the secondary market or that quote that you see on the screen, but it comes from the primary market, meaning the ability for market participants, broker-dealers, to create and redeem shares directly with us. So really the driver of liquidity of any ETF, including these, is going to be the underlying portfolio and how liquid it is. Creation or redemption in these funds is done either via cash or a combination of the underlying bonds in kind as well as cash. Bond portfolios are very, very liquid. Obviously, the Treasury futures market is extremely liquid, so ultimately what that translates into is very tight spreads relative to the underlying ETFs, particularly as it compares to the actual bond portfolio itself, and very liquid markets that are provided by the market-making community and the authorized participant community.
Great, thank you. Let's talk about the cost of this hedge. As a percentage of NAV, I'm seeing some questions coming in from the audience that are addressing that concern. Can you shed some light on it? Does it differ on the two securities?
Yeah, absolutely, because there is a little bit of difference between the two. So in HYHG, the cost of the hedge or the implementation of the hedge right now is right around 160 to 170 basis points annually. For IGHG, it's about 250 to 300 basis points annually. And again, the further up the yield curve you go, I think it makes sense to everybody, the more expensive that's going to be given the steepness of that yield curve. So the way to think about that is, and to Simeon's point earlier, ultimately the way to think about that cost of the hedge is that all things being equal, if bonds didn't move at all over the course of the year, that would the ultimate return of the portfolio would be reduced by not only the expense ratio that we quoted earlier, the management fee, but this cost of the hedge as well. Okay.
Let's have a hypothetical here. You have a client, maybe is risk averse, saying, "Gosh, I understand the risks of capital losses with the bond holdings that are a little too far out on the yield curve," and they're just like, "Gosh, I don't know. These products seem like they're complicated. I don't really want to get into any complexity. I just want to be able to sleep at night." Help us formulate, how you would handle that objection in the traffic.
I think that I would get back to this simple and surgical approach. In other words, what IGHG and HYHG are intended to do is to actually strip away that complexity. So, whereas there are many fixed income products that will use any strategy that comes to their mind to either dial up or down credit risk or dial up or down interest rate risk at any particular time, and you're not really sure exactly what they're going to do. This is the simplest and cleanest way to simply say, I want my regular investment grade bonds, or I want my regular high yield bonds, and I just want to take out the interest rate risk. And that's really the answer here, that these are in fact the simplest and most transparent ways to get that precise exposure.
And I think that's a great point that Simeon makes, and I'll actually also echo a point that he made earlier, that not only is it a transparent, straightforward approach to holding the asset class or the particular investment strategy and targeting that duration of zero, a very clean and simple way to do it, but also, again, to his point earlier, relative to other ways to manage risk or duration risk in particular in your portfolio, there's a difference between holding low duration products and holding a product that targets a zero duration. Because at the end of the day, even a duration of 2 in a rising rate environment, while it seems very low, there's going to be a negative effect on the underlying bond prices in that portfolio.
Got it. Now, you talked a little bit about where these securities fit in a portfolio. You said certainly if you felt compelled to replace entirely an existing corporate bond allocation, both on the high yield and investment grade side, that you could do it with these products. I wonder if you might give a little extra nuance there as to how you might combine these products with the non-hedged ones, and what would be the case to do that, or would you counsel clients against that? I mean, I guess what I'm looking for is a bit more of a range of options here, as opposed to one approach, just to kind of see the whole product offering in a more nuanced light, if you will.
Yeah, no, I mean, one way to think about it is, let us just suppose, as an example, that you have an allocation to investment-grade corporate bonds where there is, it has a broad mandate and it generally targets a sort of regular duration, if you will. And you kind of like that manager. You like what they do. You're happy with that fund. But you're worried about rising interest rates, but you can't call them up and you can't tell them what to do. You can take a portion of it, and the math is pretty straightforward. If that vehicle that you like had a duration of 5, and you want to cut its duration in half, take half the money from that and put it in IGHG, and effectively you still have some of your exposure to that manager you like, but you've taken your overall duration of the portfolio, down from 5 to 2.5. So the nice thing about zero is it's pretty easy to figure out how much you've taken the duration down. So that, I think, that's a common way that people will use these funds. You could just simply, take your entire allocation and say, hey, I want to take my entire portfolio duration down to 0, or you could use it as a vehicle to leave some of your existing holdings intact, but have this be the piece that makes that tactical decision to take some of the duration risk out of the portfolio.
Got it. Now, this is a question for Steve in particular from the audience. What interest rate environment would present these two ETFs with the most problems?
Yeah, it's a great question, and we get it a lot, and it's the absolute right question to think about, because remember, this is an investment strategy. The ETF is simply a wrapper. So, we tend to get bogged down in that at times. So let's keep the simple thought that there is an investment strategy with these particular indices, thus with the particular funds. And the investment strategy is they're built for a rising rate environment. So when would these particular funds underperform, and particularly underperform their long-only counterparts, right? Because when you're talking about, investment return, you should generally always look at it in terms of a relative basis, right? What are my other options? So in an environment where interest rates not only don't rise, but actually fall, that is the scenario in which these funds would underperform their long-only counterparts because of that drag created by the hedge. Anytime you buy an insurance policy, you have to pay the premium, right? And that's effectively what the hedge is. We're hedging against a rising rate environment. If rates actually fall, these funds will underperform due to that drag from the hedge. In a rate environment where all things being equal, everything just stays the same. Rates do not move at all. The funds will not underperform as much as in the falling rate environment, but they will still underperform their long-only, counterparts. So it's really that environment where rates don't rise, they actually fall, and that flight to quality trade, if you will, where money pours into U.S. Treasuries. Keep in mind, though, we have those environments. We've been experiencing a little bit of that environment over the last couple of weeks, really, since the first of the year. So again, these particular funds are not meant to be tactical trading tools. They're really meant to be core positions in a portfolio to take advantage of a macroeconomic environment or a market regime, if you will, that unfolds over a long period of time. Again, thinking back to Simeon's comments from earlier, when rates fell in this country, it took a very long time to go from short rates of 18% to near zero. When rates rise, they rise over long periods of time, and ultimately, that's the regime in which these particular strategies fit into.
Yeah, I don't know if you're comfortable talking about the outlook, but you sort of nibbled on the edges of it there. might you offer a little bit of market view here as to how you think this rate environment is going to normalize? I mean, you showed that chart where there's quite a lot of choppiness. Obviously, I think, Simeon, you said it's not a line. What is the ProShares view on inflationary pressure and how that percolates through the bond markets in terms of yields as a kind of a longer-term perspective? If these are core products, then are you showing your hand there, or are you just trying to offer as many tools as possible here?
Well, I think we're doing a little bit of both. So, we do not view ourselves as our first and foremost job is not to be market prognosticators. So we do indeed want to first and foremost give investors tools to reflect their views of the world. That being said, we're in sort of the 4 out of 5 dentists recommend state of the world right now, where most people are lining up again over the medium and longer term for rising rates. Doesn't mean you can't have a few weeks or even a few months where risk pops its head up and you see rates pull back a little bit. But most folks see an improving state of the world, companies doing better, economies doing better, and banks, Federal Reserve and other central banks returning to more normal patterns of behavior, and over time rates rising.
Yeah, and I would echo that to a word, really. And when you think about it, the fact of the matter is, much like to our point earlier, that you can't get away from the bond math, you really can't get away from the monetary and fiscal policy math. At the end of the day, regardless of all of the gnashings of central banks around the world, interest rates are at historically low levels. They're below, long-term historical averages. And as economies grow and economies get better, interest rates rise. It's a natural phenomenon. So again, to Simeon's point, we want to provide the right tools for the different market regimes. But the fact of the matter is that there's certainly a broad consensus out there that that rates are on the rise from a long-term trend perspective.
Yeah, it's hard to debate that at the end of the day. And some of these questions are, they're very mechanistic, and I think they both show that a lot of attendees here are very interested in what you guys are talking about, and there's some, not super crystal clear understanding of how these things work. So if you're repeating yourselves, bear with us all. It'll be to our advantage if you remain patient here. So is the goal for the duration of these products to be close to zero if they perform properly, and obviously for both funds?
It is. Each of the indices, and thus the funds, rebalance on a monthly basis. And at that monthly rebalance, both the long and short component of the index is rebalanced. The long side is rebalanced relative to the constituencies. The short side is rebalanced relative to targeting a duration of 0 at that monthly rebalance.
Okay. Now, here's a cost of hedging question. As rates move up, is there a liquidity risk in the sense that if rates are really moving up smartly, would everyone be shorting at that time? And might that create some kind of liquidity risk for these securities to the extent that they have that short overlay?
Yeah, that's an interesting question. And, the short answer to that question is theoretically, anything's possible. One of the reasons that we were attracted to the indices, from really the construction perspective, is the fact that they're using multiple futures contracts against each. Again, 2, 5, and 10-year on HYHG, 10, 30, and 30 plus on IGHG. So the fact of the matter is you've got 3 futures contracts to source liquidity from, and the fact of the matter is they're U.S. Treasury futures. Generally speaking, when you see increased volatility, when you see rate spikes, when you see different things going on around the world, Treasury bonds and thus the Treasury futures markets actually tend to become more liquid, not less liquid. So again, you've got this extraordinarily large pool of liquidity already in the underlying bonds and thus the underlying futures. And actually, when you see those different rate spikes in different types of rate environments, it actually only works to enhance the liquidity because there are more players and more activity within those particular assets. So ultimately, the short answer to the question is it's not a concern that we have really relative to any of those environments.
Okay, now You talked about the optimal environment. Obviously, these are designed for a rising rate environment where you have a duration of zero and everything is relatively tame compared to what could happen if you were in a regular bond fund. You talked about the hedging overlay being a drag if rates actually began to fall. What about in a flat rate environment? Can you shed some light on how this whole ETF wrapper would perform in that scenario?
Well, in a flat rate environment, another way to think about it, so as Steve noted, you're going to pay that cost of insurance. But another way to just sort of short-circuit the whole math is to just think about the following. In a flat rate environment, these vehicles are going to perform very similarly to short-duration bond funds. In fact, there's a couple of subtle ways because of the construction of the portfolio where they might even perform slightly better, but safe to say they'll perform very similar to short-duration bond funds in a flat-rate environment.
Okay. Talk about some tax questions. What's the difference from a normal investment grade or a high-yield fund wrapper with these two products? Again, from a tax efficiency perspective, is there anything noteworthy there? So something about the hedging overlay that would create a difference?
You know, generally speaking, it's always difficult to comment on tax-related questions because, you know, I am not a tax lawyer or a tax expert, but the fact of the matter is that the structure of these particular ETFs is similar to any other 40 Act registered exchange-traded fund, so the tax treatment of the ETF itself is very similar. You know, really beyond that, it's tough for us to comment on the tax efficiency of the particular fund itself.
Okay. We have a yield curve-related question here. Given the steep curve, as it sort of hockey sticks up right after the effects of the Fed funds rate runs its course and say the 3 to 7 year range, given that steep curve, going short duration, is there a greater risk of the curve flattening and underperforming when you are in these products?
A greater risk to the performance of the funds in a yield curve flattening environment? Is that ultimately the question?
That is the question.
Generally speaking, no. There wouldn't be a significant underperformance, but again, ultimately it depends on how that yield curve flattens and really the volatility, because, right, this fund's no different than the other investment fund or investment strategy. Returns are path dependent, and, you know, volatility is going to play a factor in that. So, I mean, I don't know if...
Well, I think also one of the things to note, back to the way the fund is constructed, as Steve walked through, because we're hedging on 3 points of the curve, that makes sure that there's effectively no interest rate exposure even if the yield curve itself twists, whether it flattens or steepens. So that's very importantly one of the reasons why we don't just hedge on 1 point, because if you hedge simply on the longest end of the curve and there was a flattening where the short end picked up and you were only hedging the long end, your hedge wouldn't work. So the reason we hedge at 3 different points is specifically such that the fund will do exactly what it's supposed to do in either a flattening or a steepening environment or a parallel shift of the curve.
Okay. Here's a question. This is somewhat arcane, so bear with me, but it's getting into the finer points of spreads and whether they narrow or what have you. The question is framed as this is a pure spread risk that you're left with since you're factoring out interest rate or duration. So to have conviction that these products are appropriate, you need to believe, for example, in the case of high yield, that spreads are wide and not narrow to position in these funds.
Do you ultimately, to make sure I understand the question, no. The fact of the matter is that, you know, is there an embedded spread trade in this strategy? There is, as there is with any other strategy like this relative to the fixed income or the credit markets. But ultimately, the goal of the portfolio, the goal of the strategy is to hedge the duration risk of the long bond portfolio, and that should be the focal point from an investor perspective. That, first and foremost, is the intended consequence of holding the portfolio. Ultimately, will the spread within the fixed income markets affect the return? It will. It's back to the point I made about on a near-term or short-term flight to quality basis, when those spreads, expand or contract, that is the type of environment where the fund performance will underperform or outperform relative to a long-only strategy.
Thank you. I got a long question here, so bear with me, and I'm going to read it verbatim here, just to make it perfectly clear. With respect to HYHG, the average price of high-yield bonds are above their call prices. The questioner notes that this is an odd phenomenon right now, as the above call trading prices effectively shortened duration. Now, is the duration effectively masked because of this? Now, as prices fall in high yield below par, whether that's from rate rising or credit risk aversion, this could lengthen duration, no? And you mentioned that HYHG before hedging for duration had a duration of 4.5 years. Now, how does that compare to the high yield market as a whole?
So I'll make a couple of comments. Steve may want to pile in, but first, remember that the hedge is rebalanced monthly, right? So the hedge is always rebalanced to reflect whether any of the optionality embedded in high-yield bonds is either lengthening or shortening the duration, so that every month you're at zero, and intra-month we see durations of 0.0001 or minus 0.0001. More broadly, remember that the underlying bond holdings are designed to be very close to garden variety equivalent bond indices. So, if you go back and you look at the slides, and earlier I reflected on the durations of several other high-yield bond indices, and they're all in the 4 to 5 year range, which is right where HYHG's long portfolio lies. So the portfolio itself has a duration right in the ballpark of all of the most popular high-yield indices, and that rebalancing of the hedge makes sure that any changes plus or minus in duration for whatever reason. Remember, the bigger move of duration can be if yields move. Durations are a little long right now because coupons are low. So anybody who wants to pull out their old fixed income textbooks will remember that the other way to think about duration is as the weighted average time of getting your money back. And when coupons are really low, durations are longer. So that in and of itself can be a bigger mover of duration than the optionality. But we take care of both in a monthly rebalance.
Okay, I'm going to ask a final question. We're starting to run, we're close to the end here. With regards to the holdings of the funds, Steve, perhaps you can tell the audience where they can find that on ProShares.com?
Yeah, absolutely. So on our website on ProShares.com, on the front page, you can pull up each product either through the product categories or simply in the search box, type in the ticker, IGHG or HYHG, and you'll be presented with the product pages for that particular ticker. There's a tab for portfolio holdings. And each and every day you can see the underlying portfolio of the ETF, which includes each individual bond position as well as the notional amount of futures of each futures contract that we're short.
Okay. I'm wondering if you might just indulge me just to kind of walk me through a very simple example. If rates rise, describe exactly how my experience will be holding, let's say, the high-yield product. If yields tick up, 25 bips or something, instead of losing on the price and offsetting whatever yield I have in a particular fund, walk me through. And it's a very rudimentary question, but I'm trying to see it and to understand in the traffic how these products will work.
Well, yeah, so let's look at it in the most simplistic example. And in the case of HYHG, let's say that, let's use round numbers. So the duration of the portfolio is 4. So in all things being equal, if interest rates were to rise 1%, you would expect the underlying bond portfolio to drop by 4%. This portfolio, because the duration is hedged to 0, is effectively 0, all things else being equal, the value of your short futures position in the portfolio would offset that drop. So the portfolio itself would effectively remain flat. So your return from an NAV perspective would effectively be flat, and you would still garner your yield. So you'd have a net positive yield that would effectively, in that scenario, be equivalent to your yield for that particular time frame. Again, that's all things being equal. That's notwithstanding the expense ratio and things of that nature. So it really boils down to ultimately that duration versus what the actual interest rate rise is.
Perfect. Well, on that note, I think we can call it a day. That concludes our webinar, The Power of Zero, Effective Strategies for Limiting Interest Rate Risk. I want to thank Simeon and Steve for being my guests, and I also want to thank the audience for attending and asking some good questions. I also want to remind you again that this deck, the slides will be available to you in 24 to 48 hours. You will get an email giving you instructions as to how to access it if you want to see it. On that note, on behalf of all my guests from ProShares and all my colleagues here at ETF.com, I'm Ollie Ludwig, wishing you all a very pleasant afternoon.